I think the market's going to be at new all-time highs, um, likely into July. I think probably it might even happen as early as next month. Um, it likely could happen in the next couple of weeks.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The markets have had a volatile ride so far in 2025, falling hard in March and April, but recovering nearly all those losses in May. So, was the painful drop we experienced just a standard correction within an ongoing bullish market trend? Or has this been a bear market rally, poised to roll back over soon? For insight, we're fortunate to welcome Mark Newton to the program today. Mark's the head of technical strategy at the market research firm Fundstrat, where he works with its co-founder, Tom Lee. Mark, thanks so much for joining us today.
Thank you, Adam. Nice to be here.
Thank you. All right, well, as I said in the intro, this is your first time on the program. I really appreciate you coming on, Mark. There is a starting question that I'm kind of known for asking people, and I'm realizing I haven't asked it for a while. And since this is your first time on the program, I figured it'd be a nice way to christen this inaugural appearance of you. What's your current assessment of the global economy and financial markets?
Wow. I think it's always difficult to have a very accurate picture of where the economy is. I think even most economists will tell you that just given the lagging nature of many of the indicators they study, that there certainly are a lot of moving pieces, particularly after COVID, that hasn't gotten any easier. My view is that the economy still is largely in good shape, and I take that from not only GDP but inflation, which seems to be starting to pull back despite the tariffs. The fact that the labor market is still in good shape, and also that the housing market really has not shown as much deterioration as what might be necessary to think the economy is rolling over. So, despite all the craziness, I'm actually pretty optimistic, at least for now. I think, there are some worrisome signs on the fringes when you look at credit card delinquencies and certain things. But for me, even as a non-economist, it all rests with unemployment. And until that starts to go up meaningfully, or we see the fact that housing really starts to nosedive, I'm a glass half full type person. I think very well that we could weather this and we could actually put off a larger setback for a couple of years.
Okay, so I have said many, many times on this channel with a lot of other experts that sort of so goes the employment market, so goes the economy. Sounds like you're sort of a similar mindset. And we're still near, historically low unemployment. So it doesn't seem to be, sending crisis signals right now. I mean, there's maybe some cracks we could talk about, but nothing right now that is signaling any sort of imminent concern. Okay, so given that and everything you mentioned, sounds like you said you're generally optimistic. So to my question that I sort of posed there in the introduction of were March and April more of just a correction in an ongoing bullish trend, or is it sort of a classic bear market rally that sucks people back into the market and then pulls the rug out from under them? Sounds like you think it's probably more likely the former.
I would agree with that, Adam. I think that it's very much similar to the move we saw at the onset of COVID in February. The market actually peaked on the exact same day, February the 19th, 5 years ago. At that time, we had a 33% correction and 33 calendar days, or about 1 unit of price per unit of time. This time around, we had less of a correction, and we've almost had one of the more robust rallies back to new all-time highs ever in a quickest period of time. I mean, when you look at the 20% drawdowns of the last 100 years, 1998 comes to mind, that we actually recovered all-time highs in about 32 trading days. We're at about 30. Given the weakness between yesterday and today, it looks like we're not going to get there right away. But I do sense that in a lot of my market gauges have gotten a lot more constructive with regards to breadth and momentum. It is encouraging to see technology lead us back as strong as it has. I mean, many of these companies have all improved our lives for the better. And when you see tech, have as big of a rally as it has, and still the earnings growth is still quite good in technology, That's certainly reason to be optimistic. And I would couple that with the fact that sentiment remains still quite subdued, even after a 20% move off the lows. I mean, there were certainly reasons to be, I think, concerned when the bond market started to ratchet up when bond yields started to move up rapidly in early April. But in my view, Scott Bessent had the president's year, and we had a very noticeable pivot, even if it happened behind the scenes. We saw the rhetoric grow a lot less severe, more calming, and markets certainly started to rebound in a way that caught many people off guard. And now having to sort of recalibrate their own expectation of whether they want to jump back up on the rally and try to participate or whether they're going to wait for a pullback. And so, technically, a lot of the weekly momentum gauges are back to positive. That's a good sign. My own, seasonality and cycle charts did bottom in April and honestly turned higher into about the month of August. So I think this year could play out like many. It will have probably an above average number of volatile swings, but I still sense that the bull market can last a little bit longer. And so we haven't really seen sufficient evidence of tech rolling over in a way that would really make me concerned as somebody that looks at price action and volume and sentiment and seasonality and cycles and things that really matter with regards to price action and trends.
Okay. All right. So very useful. Let me ask you this, because Fundstrat, I mean, your colleague Tom Lee is, sort of known as being one of the bigger bulls out there on Wall Street. I guess I should
Right.
ask you, would you paint yourself with a similar banner, or would you describe yourself differently?
Well, I'm very tactical because I do use technical analysis. Back in November of 2021, I'd been with the firm only 2 months, and I whispered to Tom Lee, there is some evidence that the market's going to be peaking out. And he went on CNBC, it was November the 17th, and said to them, our new technical guy, we haven't worked with him long, but I respect his views, and he thinks the market could top. And I was very lucky, but that happened to be the peak of the entire bull market for the Dow, the Nasdaq, most of Europe, Dow Jones Transports. The S&P, of course, peaked 2 months later in January 2022. But I had called for a 30% pullback from the highs. And, so after the decline, I did get bullish in 2022 and also 2023. And so, I'm very willing to respect trends when I see them or see evidence of warning signs. Back in 2021, there were quite a few. However, this time around, the market was caught off guard, and the fear turned to capitulation into April in a way that made me pretty confident that unless all the hard data immediately rolled over to join all this negative sentiment, that we could probably withstand this pullback. And it was just yet another, albeit severe correction, still within an ongoing bull trend. A final thought, when you look at the actual price trends of S&P, for example, or QQQ, we never really managed to make longer term trend breaks. We sold off in the S&P about 50% of the whole move up from 2022 to February of 2025. And so, it was a severe move, but yet, still did not get down under levels that would make me think that we're going to have a larger decline.
Okay. So it sounds like, looking at your current indicators and whatnot, I think if I heard you correctly, you could see the current rally continue through maybe August. And of course, closer we get to that, you'll certainly can call audibles when you have more data. Let me ask you this just sort of generally, because it does sound that you are, still generally positive on where things are going. When I asked you for your assessment of the economy, you said it's in good shape largely because GDP is doing okay. It's not doing great, but it's doing okay. You said inflation's moderating, jobs haven't broken down, and housing hasn't broken down, which kind of sounds like, well, things aren't that bad. Is there a part of the bull case going forward about what you think is going to get better? Are there some key pillars of the bull argument here, sort of fundamentally about the economy?
Yeah, I have to say, Adam, I'm not an economist by trade. You know, I've looked at technical analysis for 30 years, and so that's really my bread and butter.
Okay.
You know, I look at
I don't want to push you out of your lane, so don't let me.
no, that's fine. I'm not going to be as much of an expert as your traditional economist on the economy, but I would simply say that you know, housing arguably has gotten unaffordable to the average person. Yields, you know, mortgage rates. I had a mortgage rate of 3%. My wife and I just sold our house 6 months ago because I feared, you know, the start of a possible housing decline could be approaching within a couple of years, which largely lines up with an 18.6 year cycle, and it last bottomed in '09, and it should be peaking as of, you know, potentially next year or in 2027 and pull back. Um, you know, if that happens, and I think we've seen some evidence of that in the Southeast and a lot of the South, you know, that could be problematic, of course, for the economy if we see a rapid decline, you know, massive oversupply of housing. But you know, we've seen this time and time again where people turn negative and people say, you know what, well, what do you do with this information? Is it right to be in cash? And then the market goes up, you know, 20% in a
Right.
period of about a month and a half, and people are left on the sidelines. And so for me to be a real market bear, you know, I really have to see meaningful evidence of you know, market deterioration that makes me think that stocks are going a lot lower. And for this year, I think we're going to still move up towards all-time highs, even if that, you know, the economy doesn't improve materially. So, you know, I always think that's a tricky game to try to be an expert in economics when we really all lack the kind of data that we probably should have, given that it's 2025. And if there's one area to be, you know, replaced by AI, it's really the Federal Reserve, where, you know, machines should be making those decisions and not humans. And nobody cares if you miss or slip up on a word or two. It's more about, you know, making the right call on the data you have versus looking at you know, months and months and months prior, the Fed saying it's going to be data dependent is a little bit of a joke because honestly, you know, the data now is not really relevant. Uh, you know, the interest rate hikes that they saw in recent years, um, you know, it took some time, and it's really arguable whether this whole COVID imbalance of people working from home and how that affected the labor supply and the supply demand situation. Um, you know, I'd be interested in meeting anybody that could really put an accurate spin on exactly where that stands and why. For me,
Hmm.
I know it's a tough job, and I just try to concentrate on markets and how to make money for my investors.
Okay. Sorry, I'm just going to scratch at that because it was really interesting. You know, we've certainly heard sort of the debate between whether we should have a central bank that's as empowered as the Fed is to set policy and guide by its the levers that it has. And then we've heard the other side of the debate, which is, hey, the market should just set interest rates and we shouldn't really even have a central bank, or at least if we do, it should just be a lender of last resort and that's all, but let the market set the interest rate. You sort of made a middle argument, I guess, which is let's come up with the rules for what we want our central bank, how we want it to operate by, and then let's let AI figure it out. Um, I'm curious, would that be your preference, or if given the choice, would you go all the way to a market, based solution?
Well, I just don't think we have any easy answer as to what that outcome would be. We know now that the Fed has historically always been behind the curve and has always lagged in its decisions. And whenever they choose to, you know, start to ratchet up rates or pull back on rates, you know, it never seems to accurately time things. So I would give, you know, Powell a lot of credit for his guidance of the economy, but at the same time, it's an incredibly difficult job. And anybody says otherwise, you know, there's just a lot of moving pieces. I think the U.S. is still very much the leader in the world. I really disagree with many that are saying that you know it's right to sell the U.S. and start to invest abroad. And I think you know we're seeing by just the recovery on many of the Magnificent Seven companies that you know those long-term trends in U.S. versus the world are still very much in place and haven't been broken.
Okay. All right. Well, so you talked about how I mean, you're clearly a market technician. I've had a lot of people on the channel recently, given all the volatility. say that, and really all the macro uncertainty, right? I mean, every day we practically get a headline that nobody expected when the day started, right? So I, I've had a lot of guests on the program recently who have said, when it's cloudy outside the windshield, you want to look at your gauges and rely on them more heavily. So, we've got a lot of people that are relying on TA more heavily these
Yeah.
days. So I think I heard you say earlier, until you start seeing, key indicators start showing signs of weakness, you're gonna be more sanguine about where things are headed. I'm just curious, like, what are some of the indicators that you are most closely monitoring right now, given the environment we're in?
Well, first and foremost, price action really means more than anything. And when you see trends hold where they need to and start to see, the recovery in stocks, when you start to see, the kind of rally that we have gotten since April the 7th, it's caused many of the traditional momentum indicators to start to turn back positive. Really makes it very difficult to be a bear, in my view. We've had many people remain remarkably pessimistic. And obviously, coming into this administration, there were many reasons to be, um, however you want to say it, concerned about the level of potential chaos that just, Trump 1.0. We've obviously understood that his rhetoric and his talk is very different than his action, and many have sort of been, honestly very critical from day one and continue to be critical literally every day of every decision. And unfortunately, that casts a pretty big cloud of sort of dark sentiment across the economy. And people turn on their news every night and they don't know what to believe in. And they see the stock market rallying 20%. So I guess the question that I have for everybody is what do you want? What's our true goal here? Is it to make money, or is it to try to be economic experts, or do we want to really let politics enter our lives in a way that we think we understand what's going on, when in reality, that reality is probably a little bit different than what, the media and the current narrative is. And so,
Okay.
look, we all would have done things probably a little bit differently, and arguably it's a very high risk, high reward type strategy to undertake some of this one
Mhm.
year ahead of the midterms, and I don't disagree with that. I just think it's very, very tricky, just given the degree of divisiveness and polarity that this country is currently still in, to really have an accurate handle on exactly what's going on and what we know to be true when the stock market seems to be telling us the opposite. That's all.
Okay. And yeah, uh, I appreciate the argument, which is predicting the future is always hard. Um,
Well, the
but
trends matter, and until trends get violated, it's right to stick with those trends. I mean, that there are that's the whole reason I preach to investors to utilize technical analysis, is it helps one to take the blindfold off and really erase the emotion, and you can really, have a lot greater degree of discipline in investing, and immediately where you're wrong and take steps to protect profits, use hedges, and it's allowed me to be able to avoid, I think, a lot of the calamity that maybe many endured by being too long large cap technology when it became a very crowded trade. And so, at this time, I see a lot of opportunity in the precious metals and otherwise. And for those that have a need to diversify, there's certainly options now where maybe there weren't a few months ago.
all right, so you're taking exactly where I was going to take you, which is, end of the day, as you said, your job and your interest is making money for your clients, and you're going to look at the trends that are going to help you best do that. So, where do you see the biggest opportunity right now? I heard you mention precious metals. It'd be interesting to hear a little bit more about that. We have a lot of people on this channel that talk about that, so it'd be interesting to hear your take on it. But what other sectors, assets, asset classes, et cetera, catch your interest right now?
Yeah, I think it is really a fascinating time, because now that technology has rallied so sharply off the lows, and that many of these stocks are approaching so-called, overbought levels. We've seen a lot of consolidation within the precious metal space in the last 2 months, and many of those are now starting to bottom and turn back up, meaning gold and also industrial metals like silver are starting to, shine at a time when, areas like China are starting to hint at possible stimulus and starting to reawaken. So, for me, when you see a big decline in the US dollar, like, we have seen in recent months, and we've seen even this week starting to roll over again, which I anticipate getting down to the low 90s for DXY, that does present some opportunities, not only for commodities, but also for emerging markets. Areas like Mexico are interesting to me. And it's interesting that you look at the countries that have been the beneficiaries of the tariffs, and all their equity markets are going gangbusters. And countries like Canada are seeing their markets break back out to new all-time high territory, regardless of the fact that it hasn't been a lot of banks that have participated. So there certainly are opportunities outside large cap technology and U.S. equities. I would look for gold, but most particularly, I'm actually expecting a comeback in both silver and copper, which has been incredibly resilient given that many have grown very pessimistic on the U.S. economy, but yet copper is holding up and arguably close to breaking out itself. So I would recommend a healthy portion of gold in portfolios along with silver, and I would actually take a look at things like platinum, which just literally broke out, and some of the grains are also interesting. Um, People are arguing inflation. Commodities have actually been down since February, so we haven't been going up, and commodities have been going down. But that could be changing. We're starting to see evidence of some stabilization there. And, to me, that's an interesting area and also a healthy source of diversification to look to put money into the commodity space. And frankly, I like investing in treasuries. I think yields are today, the auction came in quite poor, but I think that's going to prove to be short term only. And I think that yields in general will start to trend lower and match what's happening in the US dollar over the next 3 or 4 months. And so adding duration and or favoring treasuries here, along with being long the euro, being long the yen, and the yen and gold tend to have very good correlation. I see the yen rising to about 136 to the dollar. And so, there's plenty of opportunity. For those that want to be defensive, of course, utilities is hands down really the best defensive sector. I would certainly lean there versus looking at energy, looking at staples, looking at the REITs, or even healthcare, which is still undergoing a lot of consolidation. But utilities with a lot of the power generation, utilities has quite a bit of appeal, and that's really a big area of outperformances here. So within the U.S., I would look at, technology, financials, industrials, and utilities. They've all been quite strong, and I see them continuing to strengthen. Um, Outside U.S. stocks, I would say gold, silver make a lot of sense. I'm sort of waiting on copper to make a bigger move, but I think gold probably gets to 3,800 this year. I see copper going to the low 40s. So, if it failed to make that move, and if China starts to, arguably fight back on tariffs, and then things don't work as smoothly, then that could be a problem with regards to, China's own fragile recovery. And we see Chinese interest rates at record lows versus the U.S. The spread has gotten enormous, and their economy is heavily levered to their banks are three times the size of ours, and they're levered to real estate, which has fallen 30 to 50%. So they are in dire need of some help. But I sense that I do take the optimistic view that that is starting, and we're starting to show some decent evidence of their stock market working, and the demand in areas of the metals where they tend to be one of the largest importers in the world, I think, of silver alloy. And so I think I would look at silver as being one of the areas I would put money.
Okay. It's funny because I've been talking about silver a lot recently. I just recorded a live stream a few hours before this one, Mark, and asked a very leading question of the guest about whether silver looked like it was poised for a big breakout, because it does to me. And I'm not as nearly a technical analyst the way that you are,
Well,
but I'm
silver did
curious.
in fact it is breaking out today, short term, above 33 and a half. But the question is, does it get back towards prior highs? And I think that is going to be a work in progress. But we are entering a cycle where normally silver tends to do quite well. So I'm I have a little bit more optimism. So right now I would own both, but as silver starts to strengthen, you'll want to put more assets into silver versus gold.
All right. So just around this, you mentioned you could see gold perhaps rising to 3,800. I'm guessing these are sort of end of rally or end of year, sometime before the end of the
Yep,
year.
yep.
Gold hit 3,800, copper low 40s. Is there a number you'd put on silver there? I'm not going to hold you to it, but kind of a guesstimate.
Yeah, I just intermediate term, it seems to be attractive. That the problem I have is that if rates really start to ratchet up meaningfully, then that's going to be a big negative for the metals. And I see this rally likely lasting into the fall, like September, October
Yep.
time frame. But then I see gold has already gotten very, very stretched, and silver has not made the move yet. So it has a short window where I think it needs to make this move and start to play catch up. So the low 40s would make sense for that. But
Okay.
I'm much more of a tactical type investor trader than I am making grandiose long-term targets on things, particularly if I feel that, rates being down might prove short-lived over the next few months and then they'll start to turn up again. So if the dollar starts to strengthen come end of year along with rates moving higher, then that's going to cause commodities to start to fall again, I think. And so that won't be necessarily the time. We'll
Got
see.
it. Okay. But if silver in the short term
Yeah.
punches above, let's say it hits 35, you could see it pretty easily going into the low 40s. Okay. And I'm sorry, I should have asked this question about copper. If copper has the breakout you think it would, where would you see that being?
Yeah, I think above 475 and it'll challenge April highs and get over that, which is like 495, and that'll put it up towards prior peaks that we saw back in March, which was over five. But I can see that move up into the mid fives, I think, between now and year end. The question is if the economy is truly going to start to falter, that's obviously not going to be good for copper and so I sense that the opportunity for the metals is probably, short-lived and more of like a 3 to 6 month type thing where you really want to be involved between now and the fall. And thereafter, I lose a little bit of confidence. Some of my cycles do start to turn down in the metals this fall. And so they're
Okay.
not year-end targets. They're more of a, it needs to happen, right around September, October.
Okay. All right. And, Mark, we'll have you back on,
Yep.
in late summer, early fall, so you can
Yep.
give an audible update to all this stuff. Okay. So it's funny, you have kind of the inverse outlook as Felix Zulauf, who, and granted, maybe he's updated a little bit, but I interviewed him about a month ago, and
Yep.
he thought it was going to be pretty volatile until fall, and then he thinks things are going to pick up. Right now, based upon what you can see from your headlights, it's more things are going to be good until fall, and then, right now it looks like they could be a little bit worse, but of course, we'll let you update it as we get closer. Um,
That really depends on rates starting to turn over almost right away. And today we're actually seeing the opposite. We're
Right,
seeing,
and that's where I wanted to go. So real quick,
yeah,
let's just because this video is gonna launch tomorrow from the day we're
okay,
recording it, so it'll be pretty
yep.
fresh. So the day we're recording it, Wednesday, May 21st, the 10-year surprised a lot of folks by punching up to 4.6%, more or less, on net yield. The 30-year went back up to
Mhm.
5.1%. So as you said, yields are going in the direction that Wall Street and certainly the administration don't want to see them going here. Obviously, if that continues, it probably puts a lot of what you just put on this list of targets in greater jeopardy. But your default case, your base case is still this is probably short-lived dyspepsia and yields should come down. I should note too that seems to be what happened today was a trigger as we had a weak auction at the 20-year
Right.
duration edge. Okay, so let you react to that. Did I summarize your outlook correctly?
That's correct. Look, yields have not broken above the peaks from 2023, and so arguably it's still been a very neutral trend in things like the 30-year. It's not like they've just been going straight up, and we're still in the 10-year, below the peaks that we saw in January of 481, and also right near 5%, which happened in the latter part of 2023. So, look, if we see big breakouts in yields, that will certainly change the picture very quickly. And I think in many things. But stocks, would not react favorably if we see big yield breakouts. But for now, that is not something that I'm forecasting. So of course, it could be an audible where I'm forced to but most of my work still says that things are still pretty optimistic, and I sense whether it be economic weakness or otherwise that yields should not be high for too long. It should start to roll over.
Okay. So to the folks that would say, a lot of headline readers, hey, other countries are not buying treasuries the way they used to. Some are actively reducing their treasury holdings. Um, just what would your answer to those people be?
Look, I think we've seen gradual a decrease in buy, but certainly very, very difficult to say that given the fact that most currency denominations still held in U.S. dollars. We still have a tremendous amount of treasuries that are being bought around the world. It's very, very difficult to. I know it's fashionable to want to pull that trigger and say, well, nobody's buying our treasuries anymore. But if anything, the price action overnight seems to be very different than during the day. Bloomberg had an interesting article about that recently, and a lot of their conclusion was that that was just simply not the case. That all of a sudden people are losing interest. Uh, Prior to today, the auction data actually came in quite strong over the last few auctions. There was a lot of demand. So it's interesting to see the degree that which sentiment will influence these auctions, and people right now it's all centered around the tax debate. I think we have to get past that first and figure out the degree of the budget and whether that can be we can raise the debt ceiling or not. And a lot of that's going to go a long way towards probably providing some confidence to the Treasury market. Honestly, I mean, with $37 trillion in debt, I mean, 10 trillion of that has to be rolled over this year. We certainly
Mhm.
need yields lower, not higher. So my view is that probably will be something to expect between now and August, September. As to whether it's long lasting, difficult to say.
Okay. And more to expect because the administration is just going to do whatever unnatural acts it needs to do to get the rates down to be able to refinance the debt.
Well, I mean, and that's an interesting question. Yeah, I don't know the degree, the power that any president would have to be able to cause price action. I think it's really it's really about the Federal Reserve and really the degree of cuts that are being priced in the curve and the economy. So there's always a wish that you can try to will something up to certain levels, but it's often a lot trickier. And so, if anything, Scott Bessent seems to be the voice of reason, and historically, it's been right to really respect what he's done. So we'll certainly we'll take it from there. But it's tricky. I almost always try to avoid letting any of my views be biased by what's happening around me. If it doesn't involve price, um, volume and looking at what's happening with the cycles and sentiment, that it's usually something to be avoided. And most of these things, I always preach to investors to try to avoid letting exogenous events really affect your trading whatsoever, because so many people I know have gotten so negative and really have missed a lot of this rally, and now they're trying to, wonder whether they're, if the market continues up, are they going to get more negative and they're just going to be negative for a period of years, or eventually they'll capitulate? And we know the tariffs aren't necessarily going away, but it's up to each of us to really manage according to our own sort of risk tolerance and I guess time horizon.
Okay. Just to go back to my airplane analogy, sort of sounds like you're saying, look, there's so much going on outside the window that's not helpful these days. Better just to like put blackout paint on your windshield and just look at your dashboard.
I think any given year, you enter the year with all these negatives, and whether it be COVID or almost anything. And so I just think the rapid dissemination of information these days is quicker than we've ever seen in the past, and a lot of different links that are designed to really, uh, generate clicks and sort of push us to the fringes in both direction and really try to agitate us in ways that's probably not helpful. So I think many of us are far more moderate and not extreme. And honestly, with regards to markets, I think you have to be level-headed and calm and not be to, don't let the news get one too excited, because as we know, things tend to change very quickly.
Okay. Um, well, let me ask a couple of things as we start to wrap up here. One is you were kind enough to share some of your price ranges you expect some key assets to get to. If I heard you correctly earlier, you said you think that the market could get back, you said near, let's say nearer to maybe its previous highs. Um, right now, do you expect the market to finish the year at a new all-time high, or do you sort of expect it to sort of, you know, reclaim maybe the remaining gap, but kind of end where it started the year?
Uh, I think there's some cycles that are coming about in November that could be a little bit more negative than what people anticipate. I think the market's going to be at new all-time highs, um, likely into July. I think probably it might even happen as early as next month. Um, it likely could happen in the next couple of weeks. I'm not expecting this little pullback today is going to prove that meaningful. I think it'll be about a 2 or 3 day decline in the bond market, and then yields will start to stall. Equities will regain and test all-time highs. I don't see anything that suggests that this is just, as they call it, a dead cat bounce and a fake move, and that we need to go right back to the lows and that everything's bad. We certainly haven't seen that, and so I just have to lean on everything that I've been using in recent years. As I told you, I'm very tactical. I'm not
Yep.
a perma bull. I'm not a perma bear. I certainly respect trends, and if sentiment turns very, very optimistic on a push back to new highs into the fall, increasingly I'll get a little bit more cautious for reasons that we've had two back-to-back 20% years, and now potentially another rally that could take us up another 10, 15% into the fall. Between 6,650 and 7,000 would be sort of a danger zone for, heading into Q4 if in fact that area is reached. So I'm watching everything carefully. I think it's right to be diversified, but I certainly don't mind being long U.S. stocks right here until trends or something proves me wrong.
Okay. Said like a great technical analyst, just very Vulcan. Um, okay. So, thank you. It's very helpful to have this level of specificity. And presumably, I'm guessing one of the reasons why you're optimistic right now is that stocks have moved, you know, they've created good upward momentum, but as you said earlier, sentiment still is somewhat poor, right? So there's still a wall of worry there for the market to climb, where you're saying if prices continue to move to all-time highs, everybody gets real excited, you've kind of lost your wall of worry there, right?
That's right. A lot of it depends on the degree of participation we see in sectors and pushing back to highs. And if we don't get that, if it is only technology and we start to see real enthusiasm, then that would be certainly a concern on a push to highs. But, honestly, we did not see sufficient enough price damage to think that a meaningful bear market had gotten underway, in my view. And now the degree of the rally has caught many upsides. And so many of the CTAs remain underinvested. The CFTC data that we get um, still suggests that there are shorts in the S&P. So there's a lot of people out there that are still fighting it. And we saw 11 straight weeks of AAII data, American Association of Individual Investors, which tends to be quite accurate when it hits extremes. I mean, that got in April to the most bearish we've seen only two other times in the last 30 years. So
Hmm.
it's remarkable. So we saw over 50% bears for 11 straight weeks. That's never happened in the history of the survey. Meanwhile, the technology sector is going to make 25% earnings growth. And while companies, some of them have chosen not to give guidance, and that is understandable given the uncertainty, there is no sign of meaningful negative earnings revision on tech. It's only been very minor. So, we didn't really see it either in financials, and industrials have now roared back as the dollar's been pulling back. So, the majority of the market, meaning, tech is 32%, financials are about 12, 13, and then along with industrials, that's over 50% of the entire stock market, is still operating at a very good clip and showing remarkable strength. So I guess until that changes, I'm the one that where the trends are, going in my direction. I have a tailwind. It's really up to the bears to prove to me why I guess that I'm wrong and they're right. And for all the negativity, we have not really seen enough to make me all that concerned.
Okay. I just released an interview with technical analyst Sven Henrik a few days ago. And that was pretty much the title of the interview, where he said right now it's up to the bears to make their case. If not, looks like the bulls have a pretty good
Uh,
road ahead of them here.
yeah, I know.
Um,
No,
yep, go ahead.
no, I'm familiar with Sven. He's a good guy.
Okay, he is a good guy. All right. Well, one word I haven't heard you say, and it's not a word that necessarily a technical analyst would use, is recession. But based upon what you've told me, it doesn't seem at all to, be a base case worry for you here. I guess one question I'll put out there, and it's hard because I'm biting my tongue, wanted to ask you these macro questions and saying, he's made it really clear that's not really how he looks at the world. But obviously, I think you said one of the things that would really cause you to revise your outlook would be if the unemployment rate started creeping up. And so let me just ask you this. What level of concern, if any, do you have right now that the uncertainty of the, all the trade renegotiations that are going on right now is constraining economic activity, right? That there's capex and other things that should be happening that isn't because of the uncertainty, and we're creating kind of an air pocket, like a that may have its own lag effect that might show up in a quarter or more, where we start to see the impact of the economic activity that didn't happen, and then maybe there's some layoffs, and then things could maybe start to snowball from there.
Yeah, it's a great question, and I think that uh, where you lean on that depends on sort of your view of the world right now and what you're expecting. I think people who are very negative will certainly gobble that up and say, well, it's very high, and it's obviously going to be something it affects. And those that are bullish will say the opposite. And uh, I don't see any reason to take a hard stance that's against what the market's already telling you. I just think that I think that's a very valid question. I think that certainly companies have a lot of uncertainty and a lot of concerns, but increasingly, as more and more negotiations take place, it seems like those are being answered. And if you get too negative and become too conservative and sort of miss the boat, and then things are miraculously lifted for the better, um, that's certainly something that you're going to have to face with regards to your shareholders. So I agree with you. I think it is a concern. I just never use those things as a way that I would ever use to talk to investors or manage a portfolio. It's really all about the price action. I try to really filter out all those things that possibly could go wrong or should be wrong, or concerns about spending, which are obviously tremendous. I mean, that's one thing that we're not discussing is the level of deficits and the interest on the debt, and something that if we don't do something about it, that decision is going to be made for us. So that's
Okay, it's
something
funny.
that.
So I would have asked you about that, but I didn't bring it up, thinking, well, that's too macro. But it sounds like sounds
No,
like when you're not managing a
I
portfolio, those are
obviously
worries you have.
I share your concerns, but I guess what's the key takeaway when you show when investors sit down and they watch these videos? I mean, what should their takeaway being that everything is going to be bad, and where do they go? And then all of a sudden, if equities go up another 20%, then does that give us all greater credibility or worse credibility? So I love to point out all the things that I think should be fixed in the world. I'm trying to manage money, and right now I invest money where I'm fairly confident where things are lining up where I can make money for investors. And so it's less about my views of the world where as the more we age, as a former trader myself, I traded on the floor of the CBOE. We certainly share a degree of pessimism on how we all look at markets and life, and it's, you don't want to be too bullish and be the one that doesn't see it coming. However, 8 out of 10 years, normally it's right to be bullish and ignore all that negativity. So,
Right.
yeah, I don't have any easy answer for you. I agree that certainly there's a lot of uncertainty. Companies are seeing that. What do we all do with that information?
Yeah. So a couple of things. One, you sound like a great embodiment of the you have to trade the market you have, not the market you wish you had, right? And so that's very time honored advice, and it seems like you stick to it really well. There's the old Peter Lynch quote that more money has been lost preparing for the next recession than was actually lost in the next recession, right? So you get a lot of
There have been brilliant billionaires out there that everybody pays attention to, and many of them are quite pessimistic on the world. Uh, Guys like Druckenmiller
right. Gallia, yeah.
or Jamie Dimon, and many people who share a lot of skepticism and negativity about what's going on. But I guess what's the message that we give to investors? What do we do with that information? Does that mean that we're in cash, or that we're short, or that it's time to be all in precious metals after gold is probably the most overbought we've seen in a decade, and the trends certainly are working. But at what point do we say, wow, these companies are still making a phenomenal amount of money, and the innovation is changing at a rate that many of us really can't imagine with regards to
Mhm.
AI and how that's all changing our lives. So I guess really do feel the need to stick in my lane and honestly trade the market I'm given. I'm less about making grandiose forecasts than telling you you can really make money in doing this if you do this now, and in the next few months it could materialize. And that's what's made me successful. I know where I'm wrong, and I try to give forecasts that are fairly actionable, that can lead to hopefully people making money.
All right. Well, look, you've definitely given us a long list of actionable assets to consider here that you think will do well or poorly in the next couple of months. You've given us price targets, both for the general market and a number of those assets. So you've been very generous on that. Let me ask you this. You know, for technical analysts, well, for analysts of all stripes, really, no matter what they use, they generally have a process that there's a time window that they have, their level of confidence in, degree of confidence in. What would you put for your framework and your approach? Is it like a 3 month window, a 6 month window? I kind of think of it like headlights on the car,
Yeah,
right?
generally probably between 3 weeks to 3 months. I guess it
Three
depends on
weeks
the
to three
asset.
months.
It depends on the move that's happening, the structural move. But using counter trend tools, using cycles, using sentiment, using momentum, it allows one to attack the market with many different weapons, and honestly put the probabilities in your favor. And those that choose not to use those tools and maybe listen to the Fed, or listen to the administration, or listen to otherwise, are really going to be caught, without the proper tools, I think, to make money, because even traditional fundamentals, I mean, as we all know, many of these models that use intrinsic value, I mean, prices go wildly above and below those. And so what do you do if price goes to your fundamental target and all of a sudden goes above it by 20%? Are you a seller or a buyer, or are you wrong, or do you need to readjust it? And so at least technicals can help you to strip away some of that sort of emotion that comes with trying to make tactical decisions, and just set a framework for how to look at the world.
All right. Well, look, very useful. And given the 3 weeks to 3 months sort of sweet spot of your framework, why don't we plan to have you back on here in 3 months, Mark, for an update then, unless something happens in the interim that sort of fundamentally changes how you're looking at things. Then you can come back on as soon as you like and give us an update.
That's great, Ad. No, I appreciate that, and thank you to you and others. It's great to have a chance to join you, and I do appreciate your questions.
Well, thanks. And it's been nice to get to know you. And like I said, I hope we get to see more of you here. Most important question of the interview, Mark, for folks that have enjoyed this discussion and getting to know you, where should they go to follow you and your work in between now and the next time you come on this channel?
So one can look at fundstrat.com, Fundstrat.com, and that's a website set up. Myself and Tom Lee put out, you know, independent investment research for both institutions, but also retail. We have a crypto department led by Sean Farrell, and we also have somebody that does policy. So we try to, you know, do as many things as possible to cover all the bases. And so there are different levels of memberships. We have a free trial. If you go to FS Insight /R services, and that will provide you with a way of being able to take a 2-week free trial and really understand. I mean, I personally write a market report every night that covers 4 or 5 different charts, and I do a 5 to 7 minute video that talks about the day's action and what I expect. I'm also on Twitter, on X, on Mark Newton CMT. So you can at least find me there, if not on LinkedIn, and happy to have you on board and hope we can provide some value in what you're looking at.
Thanks. Fantastic. And when I edit this, Mark, I will put up the links to those URLs you mentioned, plus your X handle there. Folks, I'll put the links in the description below the video as well. All right, and I'm so glad you mentioned crypto because I totally had that on my list and we just didn't get to it. So let me unfairly try to squeeze one last
That's
question in
fine.
with you.
That's good. Yeah.
Because on the day we're talking, Bitcoin spiked up to 109,000, hitting a new all-time high. It's come off that, I think, only slightly last time I checked. So what's your guys' when you went through all your list of stuff, you didn't mention Bitcoin or crypto. So just curious, what are your models telling you about that?
I am optimistic on cryptocurrencies for this year. I think we rally into the fall. I don't think it'll be a straight shot, similar to equities. I think we probably push up to between 115 and 121,000 on Bitcoin, and then I think we have a little bit of a short-term pullback into June. Thereafter, I think we probably push up into probably right near 150,000 or so into the fall. Ethereum is something that's sort of gaining traction as being something that's very interesting, and it's starting to come back to life. And so, Sean Farrell and his team write about many different types of coins and things you might want to discover or pay more attention to. Technically, I favor Solana and Ethereum and Bitcoin. So I think those are something that should be in all portfolios for those that have the risk tolerance for that kind of thing.
Okay, and I am not a crypto expert. Let me just ask, why not Ripple in your list? And I only ask that because we've read a lot about Ripple over the past year. I think a lot of viewers here probably don't understand what it is, but it's another one of the bigger names, but it wasn't included on your list.
Yeah, I think that could be included in probably a top 5 or a top 10. I choose to leave it at 3. Yeah, that's certainly been acting better after the decision. So that has a fair amount of appeal. It's just not my, that's not my primary area of focus. So I tend
Okay.
to leave that to our digital assets team, and I just really concentrate more on sectors and stocks and things of the sort.
Okay, but and again, peel back for me if this is your outlook or Fundstrat's general outlook. But
That's my personal opinion, technically, on where I think things are going. So,
oh, okay, so
Sean
that
Farrell,
one
they have a whole portfolio of different type
assets
of
they look at.
cryptocurrencies. So, I would encourage anybody that gets a trial to seek that up. They write about it all fundamentally, and so that's it's a fascinating area of research.
Okay. So if you want the fire hose, go sign up for that service. But Mark Newton thinks, if I heard you right, it'll go up, it'll decline a little bit, but by the fall, you're thinking 150,000 for Bitcoin. I'm just sticking on
Yeah,
that because it's kind of a
that's
big
perfectly
number.
fair. Look, I think there's still been a remarkable amount of correlation between Bitcoin and also the U.S. stock market. So they both bottomed on April the 7th. Yeah, obviously, cryptocurrencies tend to move a lot quicker. So the beta
Yep.
is double or triple, but yeah, the trends are still in very good shape for both. And so until that changes, I think it's still right to be involved. Yeah.
All right. So if my napkin math is working well, that's about a 40% increase over the next 4 months, 4+ months.
Equities might gain 10 to 15, and crypto, notoriously will be up or down more. So in this case, I think they'll both be higher into the fall. That's right.
Okay. All right. Well, Mark, look, thanks so much. This really was a total pleasure. Like I said, I'd love to have you back on in 3 months if you'd like to give an update. And if something major happens in the interim, you just give me a shout. We'll have you back on sooner. But really appreciate this. And like I said, look forward to having you back on again.
Thanks, Adam. I appreciate that. Have a nice day. Take care. Thanks for having me.
All right, well, now's the time of the channel where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by Mike Preston and John Loderer. John, good to have you back this week. Mike, why don't we start with you? Let's get your key takeaways. What this was Mark's first time on the channel, obviously a big technician. Curious to hear how much of what he said resonated with you guys, and if there's any other sort of major points of difference in how you guys see the world right now.
There's a lot of really good points that Mark made, and there's a heck of a lot of what he said that we agree with. There's probably a few points that we don't agree with, and I'll do my best to go through that here briefly. And overall, in response to your first question, what's his outlook about the economy and the world markets? Not surprisingly, he said he's optimistic. I think that most people know that Tom Lee is recently quite optimistic, and since they're close. They work together, same place, not a big surprise. But I have to say we agree with him on this, at least really short term. We're very optimistic in terms of what our technicals are telling us. Our technicals are all flashing green, and they have been for a little bit here. And so we've actually made a few adjustments to get ever so slightly more bullish. Now, I should say that we're never really in this environment of hyper overvaluation going to get really bullish, but we did nudge our hedges, and we did nudge our equity percentage to about 45% real exposure, which is a lot for us. That's not a lot for the buy and hold people.
40%? Is that where you were last week?
We were more like 38, 39% if you take into account our hedges, and we just nudged it up to about 45. Passive buy and holders are more like 60 or 70%. So we're making a pretty big call being down where we're at. But for us, it's positive. So with that, we agree with Mark. And he talked about the strongest sectors. When you asked him later about the sectors he likes, he said tech, financials, industrials, and utilities, which is interesting because we've got all of those sectors in our model right now. Because we're always looking at relative strength and good chart setups. So it's no surprise that he's seeing things similar to what we're seeing. I think the next point I think we disagree with. He says he doesn't see a setback for at least a couple of years or a few years. I think he said it's anyone's guess, but we actually think that setback is likely to happen later this year, early next year. Perhaps. We don't have to guess, though. We're just going to keep looking at our indicators. Just don't really see how we're going to get that far, and nobody knows because we're all using game theory here because the Fed is not data dependent, like he pointed out. They are not data dependent. They haven't been for a long time. He actually said it was kind of a joke, that the Fed says that they're data dependent. They basically just do whatever they need to do to rescue markets. And that a possible solution to that would be to establish a set of guidelines and rules for the Fed. We agree. I don't think that's going to happen until we see some kind of crisis, but it would be nice to see that. So he said that we had a 21% pullback in the S&P, which is absolutely correct. And the fastest or one of the fastest moves back to near all-time highs ever. It was pretty amazing. We did see some pretty consistent bearishness. He talked about, I think, 11 weeks of AAII in a row, straight bearishness. It's true. But it was pretty breathtaking. Our own indicators were really, really washed out. Bullish percents, which is one of the things we look at. We're way, way down in the single digits. They don't get there that often, and they've snapped back to near overbought levels in just a few weeks. So we have to be careful about not calling a high just because they're getting slightly overbought, though. We've learned through experience that things can slingshot and go a lot further than you'd expect. Now, whether we think it's going to go on for years, no, we don't think it's going to go on for years. But short term, weeks to months, it certainly looks bullish here, and that's why we made the changes that we did. He talked about gold, silver, and copper. A little later, maybe we'll bring up a chart of silver. This is music to our ears. We've been big bulls in gold and silver for a long time. Silver has been lately a little frustrating because it hasn't followed suit with gold, but we think it's actually starting to right about now. And his targets line up with targets that we've talked about on this program many times. Gold, 3,800. We've said 3,800 to 4,000 in the next year. Silver, he says once we go through 35, we should see 40s. We've been saying 38.40. Perhaps once we break this top of 35 in silver. So we agree, and we continue to hold not only miners, but recommend bullion for our clients as well. Finishing up here, he said he expects new all-time highs in this market. I've got to agree. We've got a pretty good down day today, and we'll see if it carries on a couple days or not. But let me just actually pull up a quick chart of the S&P here, because I think it'll be good to just talk about that as I mention this. So here it is coming up now. You should be able to see that right around now. Here's the chart of the daily chart of the S&P. All these little lines I've got written all over the place. These are all consolidations. This turned out to be a fake out here back at 61.47. But there's that 21% just straight down move. And we had this death cross right here, and nothing in life is that easy. And so this death cross actually ended up being a false signal. And we've had this really fast move back in the S&P, which has actually created a golden cross now. So we didn't actually back test this or look at it, but one of the fastest death crosses followed by a golden cross that I've ever seen. So this death cross, at least so far, turned out to be a fake out. We've had a breakout here based on the China deal news or purported China deal news. We had some big progress on talks on the tariffs, and then it was like 6 straight up days followed by today. So we'll see what happens here, but everything's working out for the bulls, and these highs are not that far away. So I would expect some consolidation, a breakout here, and yeah, I too would expect all-time highs. He said June, July, August. I think it could happen as soon as in the next few weeks. And then from there, we could get a squeeze even higher. So be careful about calling a top here. I could say that we're not heroes. We're not 80% or 100% in. We're going to probably stay right around where we're at, 45% with a good chunk of cash. We've got hedges, although we've lightened up most of those right now. And we're just going to let this thing play out here over the next few weeks and see what happens.
Okay. And I do want to give you credit, Mike, for, I would say, the past month or so. You've been saying on these weekly sessions that you think the odds are to the upside for the market. And of course, you guys have been watching and basically taking some of your hedges off and then now increasing your percent equity exposure. So it seems like things have been playing out the way that you thought they were likely to, at least so far.
So far, we've learned to be humble in this business. I mean, for instance, we just nudged our equity exposure up yesterday a few percent, and here we have a big down day today. That could have been timed a little bit better, to be honest, but we don't know what's going to happen day to day. We don't have to. The trend for the moment is up, and Mark kept talking about the trend. The trend is definitely up, and just because we've had one down day doesn't change that. If this down action were to continue, then some of our indicators will flip, some of our stops will be hit, and we'll reduce right back down. But thank you for that, Adam. And we don't have to be heroes, and we're not trying to be heroes. We're just trying to get a little bit of return for our clients, or some of the return of this market without a lot of risk.
Okay. All right. Well, look, John, I'm going to come over to you now. So Mike was just talking to us about stocks. I want to talk with you about bonds. We've had 2 bits of material bond news recently. One was on Friday. The Moody's rating agency downgraded the United States' national debt rating. There's a lot of hand-wringing over that, although markets did just fine until today. And then today, as I talked about briefly with Mark, we had an auction, a 20-year auction that was lighter than expected, and all of a sudden that really seemed to get bond investors spooked, sending the 10-year yield quite quickly up to about 4.6%, also sending 30-year yields back up to previous highs of 5.1 or previous, relatively near-term highs up to 5.1. So what are you seeing right now? What should viewers be taking away as the sort of so what of those developments, if anything?
Yeah, thanks, Adam. Great to be with you. Yeah, I mean, we have to pay attention. Mike gave a really good synopsis of our take on the market. I don't really have much to add there. And your guest Mark, I think his kind of reliance on technical indicators, broadly speaking, is something that we also use. We use a broad battery of tools, not just price trends. We look at breadth indicators, uniformity indicators. These things in concert help to paint the picture that, broadly speaking, is suggesting further upside here, and we'll respond as those indicators change and if and when they do. But the bond market also is sending some signals, and there are lots of armchair quarterbacks, experts here about the economics and budget talks and things like that. But the bond market is telling us something. Whether that message continues to be what it's been of late, we'll have to see. But we've had some pretty notable technical weakness in the bond market, and of course that expresses in the form of higher yields. But let's talk about the Moody's downgrade. It came after the market closed on Friday, like these kinds of announcements usually do. And in a nutshell, we think it was basically just kind of a smoke and mirrors, more or less. It was arguably it was a press release that could have happened over 10 years ago. In fact, they were the third and last rating agency of the major agencies to downgrade the U.S. ratings. And I
Mhm.
just want to share a kind of a chart here. I just put a kind of a brief video on our YouTube channel talking about the downgrade. And if we look back here, so back in August of 2011, S&P lowered the rating, the first agency to do so, from AAA to AA plus. That was August of 2011. And then Fitch followed suit in August of 23. And then, of course, Moody's just this past Friday. Now, the Moody's announcement was credible in the sense that it highlighted some structural issues that, frankly, have been in place for a really long time. So the timing of the release was kind of, a little bit of perhaps gamesmanship and maybe trying to inject something into the current ongoing policy debate. But the structural things they talked about, rising debt loads, increasing interest payment loads, increasing share of debt as GDP as a percent of GDP. These are all things that are not new. In fact, you look here, back in 2011, the total debt was under 16 trillion. Now here today, we're more than double that.
Yeah.
You look at the debt to GDP, it was under 100% back in 2011. Now we're over 120%. So the problem's just gotten worse, right? So, but the downgrade itself wasn't very newsworthy in that sense. And of course, the markets originally just kind of sloughed it off. There was some pre-market weakness in reaction to that, but by the end of trading on Monday, the markets were pretty much unfazed, unchanged. And I want to kind of talk about what's happened to the yield curve. And today's auction was a little bit of kind of a shocker, I suppose, that the 20-year auction had a very weak participation. The bid to cover there's a lot of technical jargon we could throw out here, but in a word, it was a very lackluster auction of Treasury debt, suggesting the buying public, both domestically and abroad, is getting more nervous about buying longer term debt, at least at these interest rates. In other words, they would want to see higher interest rates. So this is a chart. I think this is pretty interesting. We oftentimes talk about the 10-year as kind of the bellwether interest rate curve, and indeed it is. But I've got three dates here. So I've got today's date. The blue curve here is today's yield curve. And it starts at the very low end of the curve, the overnight, Fed funds rate, all the way out to 30 years. Okay. And I've compared that to the interest rate on January 14th of this year, which, as your guest Mark pointed out, that was the high so far this year of the 10-year Treasury yield at 4.8. And then I've got the kind of the bond market panic on April 11th that arguably was the thing that caused the administration to kind of put the 90-day pause on tariffs. The bond market was kind of freaking out. But what we notice here is that the curve is, let's compare it to the January 14th curve. What we've had here is, most of the curve has pulled back in yields. Even the 10-year is, decently below where it was on January 14th. But the long end of the curve, 20 and 30 years, it has eclipsed where the rates were on the long end back then. And even quite a bit higher than on uh, April 11th, when the bond market caused the tariff policies to kind of get put, so this is a pretty concerning thing. This is you call it the bond vigilantes, a little bit of a riot in the bond market, and it's something to be very mindful of. If we look at, we oftentimes will talk about like TLT. We actually own a small piece of TLT. We've actually been very underweight for lots of good reasons. Long-term bonds. We've got like a 7.5% allocation to that. Um, and we took action much higher to reduce that position to the current modest allocation. TLT has, it's flirting with, some really important support levels. If I look at a longer term chart here of TLT, I'll just bring that up. And this holds 20 plus year treasury bonds. So this is affected by that longer end of the curve. We're at a key level here, right in the 82, 84 areas, where this prior support is. We've taken out a short-term support here, at least temporarily, at 84. And we'll see if that sticks. If that continues to stay below there, that's a technical signal that would likely cause us to maybe even peel back a bit more exposure there. And not a time to be complacent, in our opinion. So Mike talked about us being, intentionally underweight stocks. We're also very underweight bonds as well for that reason. So compared to a traditional kind of 60-40 portfolio, we're underweight both stocks and bonds. And I guess the last thing I'll say here is this is not just a U.S. issue. In fact, if you look at major sovereign debt across the world, yields are going up across the board, and they have been generally for the last several years. And you look at Japan, for example, the long-term Japan bond is spiking the interest rate. And part and parcel with that, the correlation between stocks and bonds has gone positive when traditionally these things are thought to be non-correlated. In other words, when stocks go down, bonds go up, and vice versa. For the last handful of years, the rolling 3-year correlation between stocks and bonds, not just in the US, but globally, has gone positive, which means they kind of trade together. They're not the usual diversifier. And that's where things like gold come in and precious metals. We've been longtime bulls. And this reminds me, I think Ray Dalio made a very good point in response to the Moody downgrade. He said, look, the real risk isn't that the US defaults because we have a printing press. We can just print all the money we need to pay that debt. The real risk is that we debase the currency, and that's likely what would happen far before any kind of default. So it's not about credit rating, it's about what happens to the purchasing power of the dollar and the sanctity of the dollar. And that's why things like precious metals have been, we believe, very strong and likely will continue to be so, because it's basically the ultimate safe haven hedge against those kinds of actions, which almost seem inevitable the way things are shaping up. So I'll
right.
stop there. That was a long-winded
No. It's all great stuff. And Mike, just to give you a heads up, speaking of precious metals, I'm going to come back to you in just a minute or so to close on silver. All right, John. So you showed that chart of TLT and saying that it's in danger of continuing to break down in price, and if it goes much lower, I mean, it's kind of right at the limit right now. If it goes much lower, it's going to be a breakdown into a whole new different price range. Presumably, were that to happen, I don't want to put words in your mouth, but were that to happen, not only would that be concerning about bond prices, but I'm guessing it would make you more concerned about equity prices as well. Meaning, the higher that yields go, so bond yields and prices are seesaws, right? The higher the bond yield, the lower the bond price. The higher bond yields go, it places strain on the overall economy, makes it harder and more expensive for companies to do business, and then starts becoming a drag on corporate profits. So, A, is that true, or are we not close to the range at which you think we should be worried about bond yields having that drag effect?
Yeah, there are two elements to that. Certainly, especially as companies and governments start to have to refinance debt, higher interest rates means that the debt burden, debt servicing burden becomes greater, cuts into profits and things like that. That's a more slower moving thing because many companies and countries still have debt that was locked in at interest rates, and there's kind of an oncoming wave, maybe not a wall, but there's an increasing amount of debt that needs to be rolled, and that's a factor. And that one maybe is a slower moving one, but categorically higher interest rates make bonds relatively more attractive. At some price, bonds become attractive, right? Or some yield. And that's the whole way of markets saying, hey, we're concerned. We need interest rates to go higher for us to be less concerned about these bonds, right? So yeah, at some point, being able to lock in a guaranteed yield, the U.S. government's probably not going to default. It may have to print money out of thin air like it's done in QE and things like that. But one can lock in a guaranteed yield so long as they hold those bonds to maturity. Yeah, at some point that becomes really compelling, and buying stocks and especially U.S. equities at near record valuations of all time, literally, is not so attractive in that context. So those two factors, yes, we think will ultimately, cause real economic damage, but also a shift or a fleeing from equities into things like fixed income at the right interest rates.
Okay. And then real quick, we could probably talk for a long time about this, but a question I asked earlier today that I wanted to get to Mark and I just didn't get a chance. When we talk about weak bond auctions for U.S. Treasuries, and it brings up the chorus of people who say, see, the rest of the world doesn't want to own our debt. Um, that's the risk that America is slouching into, is that nobody wants to buy treasuries and then the rates are going to go through the roof. I have no idea where rates are going to go, but I think a good question to ask is, okay, so if you're a sovereign buyer and you decide I'm not going to buy US treasuries for reason X, Y, or Z, whose debt looks more attractive to you?
Yeah, and I want to be cautioned that we don't want to make too much out of one auction. There's
Absolutely.
plenty of track record for a poor auction to be followed up by a really strong one, right? You don't want to read too much into one day's auction like today's, right? It's just another sign or piece of data that you want to take into account. But yeah, I mean, but there is competing, places for capital. We've seen central banks the world over not only say they were going to and continue to say they were going to, but they have done so. They've diversified their reserves into more and more things like precious metals. There was a survey that the World Gold Council did, for example, I think a couple of years ago, that asked the world central banks, do you have plans to increase, decrease, keep the same your purchases of U.S. Treasuries as a reserve asset, if you will? And there was an increasing number that said we plan not only to decrease, but also to increase things like precious metals in our reserves. So there's competition for these reserve dollars, and at some level, the interest rate makes the bonds more attractive relative to others, and that's really what the market's trying to do right now, to sort out where is the market clearing interest rate to put at ease some of these understandable concerns. We've got some budget antics and debates going on in Congress right now, and so far we have not really solved much in terms of the spending side of the equation and the revenue side of the equation. We're talking about tax cuts, extension of tax cuts, expansion of tax cuts. From a big picture budget standpoint, there's some troubling things that have a lot of people, I think, rightfully concerned about what the path is here. So we just got to let it play out. And the reality is we're a couple headlines away from a change in policy that could just make things look suddenly different, right? So we have a very wide probability distribution here, and a lot can happen. So what do we do with it when you can't know that future, and you never do, but when the range of outcomes is appreciably wider, like we think it is? You express caution by being underweight these things that are subject to such uncertainty.
Right. And you use risk mitigation. You lean on your risk
Yes.
mitigating tools more heavily. And we've talked in many sessions in the past how you guys at New Harvard do that. That's really kind of your bread and butter, right? Your the way in which you use hedges, largely with options protectively in case your base case goes wrong. All right. So a great answer. And yes, there's there's a lot of sins of America's past and present that we're still, trying to work through, and we may not, right? I mean, the latest numbers just came out for this big, beautiful bill, and they don't look good at all from a deficit and debt increase standpoint. But there were sort of 2 points that I wanted to underscore, and you did a good job of underscoring at least one of them, which was, well, let me say the first one is you can come up with lots of reasons not to be in love with U.S. debt right now. But if you are a foreign country and you need to deal in debt, it's not like there's another country right now that just looks great in relative comparison. We just saw also this week, the Japanese yen, or sorry, the Japanese bond yields go bananas. So, it's not like there's a darling out there that looks substantially better on the bond side of things that looks
Yeah,
better.
it's global. Most of the major developed bonds are yields are rising.
Right.
It's a
So
symptom of
that,
the yeah.
yeah, so because of that, I just caution people to be a little cautious about leaping with, grabbing with both hands onto the nobody's going to want U.S. debt going forward, right? There's a whole bunch of
Totally agree.
structural reasons why it's hard to displace the Treasury, just from a market breadth and depth standpoint, but also just from a relative attractiveness. As I said, there's just not another, super competing alternative out there debt-wise. Now, there are other interesting and more appealing assets out there, and you took it where I wanted you to take it, which was to precious metals. And we're seeing that happen. We've been seeing it happen for a good long while with central banks, but that continues to build. And folks, if you didn't see the live stream I did earlier the day we're recording this video, that I did with precious metals expert Andy Schekman, he goes really deep into a lot of the sort of unprecedented things we're seeing right now in the precious metals market, particularly in terms of just big purchases being made that are pulling bullion from other parts of the world into other parts of the world. Countries repatriating their gold, but basically huge demands for delivery from the COMEX and the LBMA at such scale that it's hard not to think that there's probably sovereign nations behind this. It just seems he sees a lot of indicators that suggest that countries are just saying, hey, this is a time where I want more gold in my treasury, and I want it actually not stored in some other country for me. I want it in my own country's borders. All right, Mike, and that's the segue to come to you to close out here. We only have a couple minutes left, but silver. So when I talked with Andy Schekman earlier today, we talked a lot about how silver looks. I mean, this is all probability, so who knows if it's going to happen, but more often than it looks poised for a big move here. Sounds like Mark sees the same thing. So can you just show us the latest charts?
Absolutely, be happy to, Adam. What's happening in silver right now is really exciting, and I think to tell the story well, I really kind of have to start with a chart of gold. So the first chart that's going to come up is a chart of gold. And so here's a monthly chart. It's a 20-year chart of gold. And we were talking month after month about this big base here. And when you've got a flat basing pattern like you see here, three tops and then a subsequent breakout, oftentimes, not always, but oftentimes, it's before a big move. And we saw a big move in gold over the next year and a half. After that, this level right here is about 2,000 in gold. And boom, we broke out, and that really hasn't looked back. And now gold's been consolidating up here between 3,200 and 3,400, and we think that's going to break higher. Frustratingly, for silver bulls, it's been a slower process. Take a look at the monthly chart of silver. Silver's been basing out here and has yet to really break out through that $35 level. But I'm going to go to the weekly chart, which I think paints it better than any. Here's a weekly chart of silver. We've had multiple bounces off the 50-week moving average here, and we have really three tops. And this is the ETF for silver, but I'll tell you that so the numbers are slightly off, but this is 35 on silver spot. This is about 35 on silver spot. And so far this week, we've had a nice big up move, and we're challenging that 35 level in silver spot. In our opinion, if we break through there, we could easily accelerate in silver. And we would expect that to bring us to 38 to 40 in silver, like we've been saying for quite a while here. We just heard Mark say 40s. And then we might actually start to see silver outperform gold. Right now, that hasn't happened yet, but we're watching very, very closely the data to see if it does. Also, miners over the last few weeks and couple months, gold and silver miners have been outperforming bullion. So keep an eye there, and that continues to be the case. So we're favoring the miners. But if we're right on silver potentially breaking out higher here, I think it'll start moving faster than gold. And I think the miners will do even better. And we will look for all of those things to, for consistency. And if we start to see any change whatsoever, we'll make some adjustments. But the silver is exciting here because it's staging a breakout similar to the one I showed you on the monthly chart in gold. So if we break through 35, pay attention. It could easily accelerate.
All right. Well, look, thanks, Mike. And of course, we'll have you guys on weekly going forward, so that as the story unfolds, you can be, chronicling it for us in real time. All right, gentlemen. Well, look, thanks so much for staying with me for yet another great interview. It was nice to have Mark on, a new face. Folks, I got Mark on because I reached out for Tom Lee. Tom was busy, but Mark was able to come on. So that's nice. And again, folks are always asking me, hey, can you get not only some new voices on the show, but you get a lot of people that seem pretty concerned about where things are headed, where the bulls. I'm really trying to bring on some more bulls, or at least people that are not afraid to take bullish positions. So hopefully you're liking that addition to the roster. And if you do, please let us know by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Because there's been a lot of talk about gold this time around. Just want to make sure if you haven't read it yet, you can get our free guide to buying and storing gold and silver, which is basically just a really good overview of all the different ways in which you can own precious metals and when it makes sense to hold in what form when. So if you haven't read that yet, you can get it for free over at thoughtfulmoney.com/gold. And if you'd like some help in navigating your wealth, your financial wealth through this market, whether it plays out the way that Mark thinks it's going to happen, whether it plays out the way New Harbor thinks it's going to happen, or whether it plays out a totally different way. Most people watching this video would benefit from getting the guidance of a good professional financial advisor, especially one that takes into account all the macro issues that Mark talked about here with me today. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you just like a second opinion from a firm that meets those criteria, perhaps even John and Mike and their team there at New Harbor Financial, then schedule a free consultation with them by filling out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. You'll get bespoke, personalized guidance from these guys based upon your own unique situation, and there's no obligations involved. It's just a service they offer. All right, John and Mike, can't thank you guys enough. Really look forward to seeing you guys next week, but always great to see you guys.
Great to be with you again, Adam, and have a great holiday weekend, and we'll see you next week.
Thanks, Adam. It was great to be here with you and Mark today, and we'll see you soon.
All right, and everybody else, thanks so much for watching.